It's January 23rd, 2026, Friday afternoon. For the better part of the morning, I have been staring at my terminal, and the silver ticker was blinking $99.10. But here's the thing, the number on the screen doesn't matter anymore. The physical market has gone silent. I'm going to be direct with you. I've spent over a decade in the commodities trenches, managing physical positions and navigating these exact moments when price discovery breaks down. I built this channel because I got tired of watching low-quality AI content flood the silver space with recycled narratives and zero real-time data. I have access to Bloomberg terminals, vault reports, and institutional feeds that most retail investors will never see. That's not a flex, it's just the reality of why I can bring you this information 12 to 18 hours before CNBC even touches it. Right now, the mainstream financial press is spinning this as a speculative mania. They want you to believe this is another Reddit-fueled bubble, another GameStop moment where retail traders pile in with FOMO and get crushed when the smart money exits. But the screen is lying to you. While that digital ticker blinks $99, the vaults are emptying. This isn't a bubble driven by hype. This is an eviction notice for every paper short position that thought they could suppress this metal forever. The banks aren't just losing money on their derivative books. They're losing control of the physical metal itself. And I'm going to show you exactly why it's about to get significantly worse. Here's my thesis, and I need you to understand the stakes before we go deeper. Silver has officially decoupled from both the US dollar and gold. It has transitioned from a precious metal investment into what the Chinese government is now calling a national strategic asset. We are watching global inventories face a total systemic collapse in real time. In this video, I'm going to break down the lease rate spike that's currently paralyzing London's bullion banks run the actual math on the 26% COMEX drain that happened in the last 7 days. And then I'll share my personal battle plan for what I'm doing around this $100 breakout. The promise I'm making to you is this. We are inside a once-in-a-generation price discovery window. If you don't understand the mechanism behind what's happening, you will be shaken out by the volatility. I've seen this movie before in other commodities, and the people who survive are the ones who understand the structure beneath the chaos. So let me give you the on-the-ground reality as of a few hours ago this afternoon. Silver is screaming at $99.10. Gold is knocking on the door of $5,000, sitting at $4,966 as I was checking the data. The dollar index is at a 2-week low, hovering around 100.2. But here's what's critical. The dollar weakness is not what's driving this move. That's the narrative they want you to believe because it's simple and it fits their models. What's actually happening is an inventory war. The COMEX registered silver stocks, the physical bars that are available for delivery, dropped by 26% in a single week. 33.45 million ounces just vanished. Not sold to retail stackers at the coin shop, not melted down for industrial use. Gone from the deliverable category into the hands of large institutional players who are taking physical settlement and removing it from the system. Stop for a second. Look at the chart of registered COMEX stocks if you're following along on your own terminal. That vertical drop isn't just a price move reflected in inventory. It's a vacuum. It's what happens when the people who wrote paper contracts suddenly realize they might actually have to deliver real metal, and the real metal isn't there. Now let's talk about the East versus West dynamic, because this is where the structural shift becomes undeniable. China implemented an export control on silver in December of 2025. I covered this in a previous video, but the implications are now fully playing out. Silver is classified as a strategic asset in China. They are not exporting. Period. This is not a tariff situation where you can pay a premium and still get the metal across the border. This is a hard stop. The result? Asian premiums over London, and New York spot prices are now $3 per ounce. $3. In a normal functioning market, arbitrage would crush that spread in 48 hours. Traders would ship metal east, collect the premium, and the gap would close. But the metal isn't moving because there's nothing to ship. The West is running out of silver and the East has locked their vaults. Yesterday, we saw a 24% flash crash in Indian silver ETFs. The retail crowd in Mumbai got absolutely destroyed. Stop losses triggered, margin calls went out, and the narrative was that the bubble had popped. Classic shakeout. Except the price roared back 17% today. Why? Because the institutional players who triggered that flush knew exactly what they were doing. They needed to clear out the weak hands before the next leg up, and it worked perfectly. What you're watching is the paper price fighting against physical reality, and the paper is starting to tear. Let me teach you something that most people in the silver community don't fully understand, because if you grasp this, the rest of the move will make sense. We need to talk about lease rate spikes and what they actually mean. This is the mechanism behind the chaos. A silver lease rate is the interest rate that a bullion bank charges to lend out physical silver bars. Think of it like this. A mining company or a manufacturer needs silver for 3 months, but does not want to buy it outright. They go to a bank like HSBC or JP Morgan and say, lend me 1,000 ounces for 90 days. The bank charges them an interest rate for that loan. That rate is the lease rate. In normal market conditions, the silver lease rate sits near zero. Sometimes it's even negative, which sounds insane, but just means the bank is paying you to take the silver off their hands temporarily because storage costs exceed the risk-free rate. It's a sign of abundant supply and low demand for physical metal. Here's the simple truth that changes everything. As of this morning, the lease rate hit 8%. 8%. Let me explain why that number should terrify every short seller on the COMEX. When lease rates spike to 8%, it means the bullion banks are so desperate for physical bars to cover their obligations that they're paying emergency level rates just to borrow metal for a few days. This is not a market signal. This is a distress signal. Think of it like a car rental counter. Normally, renting a car for a day costs you $30. But imagine you walk in and they tell you it's going to cost $500 for 24 hours. You'd immediately know something is catastrophically wrong. Either there are 0 cars left in the lot, or there's been a natural disaster, and everyone is trying to flee the city at the same time. The price isn't reflecting normal supply and demand, it's reflecting structural panic. That's what an 8% lease rate means. It means the banks can't find the metal. The vaults are empty, the contracts are coming due, and the only way to convince someone to part with their physical bars is to pay them a rate so high it's borderline usury. This signals what I call a structural credit crisis in the silver market. The paper derivatives that the banks have been trading back and forth like poker chips are now being called in for physical settlement, and there aren't enough chips to go around. Here's why this matters for price. When lease rates hit 8%, the short squeeze transforms into a physical panic. The banks can't just close their positions by buying back paper contracts. They need actual metal. And the only way to get people to sell physical metal in a shortage is to teleport the price higher, so high that it shocks long-term holders into liquidating. That's the game we're in right now. The price isn't rising because of retail FOMO or speculative mania. It's rising because the largest financial institutions in the world are trapped, and they're bidding against each other for a finite resource that they promised to deliver but never actually owned. Now let's run the math, because numbers don't lie even when the narrative does. I'm going to give you 2 scenarios, one conservative, one stress-tested. You can decide which one feels more likely based on what you're seeing in the macro environment. Conservative scenario, we ignore all the squeeze dynamics, all the short covering, and we just look at the fundamental industrial deficit. The solar industry alone is consuming 250 million ounces of silver per year, and that number is growing at 12% annually as countries race to meet climate targets. AI data centers, the chips, the connectors, the thermal management systems are adding another 80 million ounces of annual demand. Electric vehicles, 5G infrastructure, medical devices, the list goes on. Even if investment demand from retail stackers and ETF buyers stays completely flat, we are looking at the 5th consecutive year of a structural supply deficit. Mining production is maxed out. There are no new mega projects coming online for at least 3 to 5 years because of permitting delays and capital allocation issues. What does that mean for price? The floor is no longer $30. It's not even $50. Based on replacement cost and incentive pricing for new mines, the new floor is $84. That's not a bull case, that's the bear case floor. Now, the stress test scenario, and this is where it gets interesting. There's a rumor circulating through institutional channels about a 400 million ounce short cover position on the Shanghai Gold Exchange. I can't confirm it's real, but I can tell you the chatter is coming from people who manage 9-figure commodity books. If that 12,441 ton order is legitimate, the COMEX doesn't have enough registered silver to cover even 10% of it. Let that sink in. 10%. The entire COMEX registered inventory right now is sitting at around 120 million ounces after the 26% drain. If a single institutional player or sovereign entity tries to take delivery of 400 million ounces, the exchange would have to declare force majeure or settle in cash. And if they settle in cash, every other contract holder is going to demand physical delivery immediately because they'll know the game is over. Now let's talk about the gold-silver ratio, because this is where the math gets truly explosive. The gold-silver ratio just dropped from 82 to 50.1 in the last 30 days. That's the fastest collapse in the ratio since the COVID panic in March of 2020. Historically, the gold-silver ratio has averaged around 15 to 1 over the last century. During certain periods in the 1800s, it was as tight as 10 to 1. If gold is sitting at $5,000 and the ratio reverts to its historical 15 to 1 average, silver isn't a $100 play. It's a $333 play. I'm not saying we'll get there next week. I'm not even saying we get there this year. But the math says that if gold continues its run towards $6,000 or $7,000, which several central banks are now positioning for based on their buying patterns, and silver reverts to its historical relationship with gold, then $100 is just the opening act. Let me recap what we know at this checkpoint. The vaults are emptying at a 26% weekly drain rate. The lease rates are at crisis levels of 8%. The East has stopped exporting and is hoarding silver as a strategic asset. The math says $100 is not the top. It's the beginning of the next phase. But I need to steelman the skeptics here, because if I don't address the counter argument, you're going to hear it from someone else, and it might shake your conviction. The skeptic argument goes like this. This is a blow-off top. The RSI is screaming overbought. Silver is trading at an RSI of 87 on the daily chart. A $15 flash crash is mathematically overdue. Anyone buying up here is going to get slaughtered when the momentum breaks. I've heard this argument in every commodity bull run I've ever traded, and it's not wrong in a normal market. But this is not a normal market. Here's the rebuttal. In a physical shortage, RSI doesn't matter. You can't print silver to lower the RSI. You can't issue a press release that magically creates another 50 million ounces of deliverable inventory. The time lag to bring new mining supply online is 3 to 5 years minimum. You have to discover the deposit, permit the mine, build the infrastructure, and then start digging. There is no fast solution. The myth that needs to die right now is this idea that high prices will bring out the scrap supply and flood the market. Oh, at $100, everyone's going to sell their grandmother's silverware and crash the price. No, they won't. At $100, most people are going to wait for $200. Human psychology doesn't work in reverse just because the price goes up. People who held silver from $30 to $90 did not sell because they believe it's going higher. A move from 90 to 100 isn't going to change their thesis. If anything, it confirms it. But here's the thing the exchanges can do to kill this rally instantly, and you need to be ready for it. Let's talk about what happens next, because the institutional reaction is predictable if you've been through these cycles before. The CME group, which runs the COMEX, has a playbook for runaway commodity markets. They will hike margin requirements by 50% or more, forcing leveraged traders to either post more cash or liquidate their positions. They might even shut down trading servers for technical maintenance during peak volatility. I've seen them do it in crude oil. I've seen them do it in natural gas. And they will do it here if they feel the market is disorderly. The goal is to trigger paper liquidations, force the speculative longs to sell, create a waterfall decline, and give the shorts a chance to cover at lower prices. It's a reset mechanism, and it works, at least temporarily. The media narrative will also shift. Right now, the coverage is mostly confused. Silver rallies on inflation fears. Reddit traders target silver again. It's lazy and surface level, but when the price starts threatening the stability of major financial institutions, the tone will change. Expect op-eds about how silver speculation is dangerous for the economy. Expect calls for regulatory intervention. Expect the narrative to be that retail investors are hurting themselves and need to be protected from their own greed. It's all designed to discourage new buyers and shake out the existing ones. So here's my dashboard. The 3 things I'm watching to navigate the next phase. Number 1, the $100 psychological handle. If we break above 100 and hold it for 48 hours, that's a massive technical signal. It means the resistance has turned into support, and the next leg up is likely to be violent. But if we touch 100 and immediately reject back down into the mid-90s, that's a sign the sellers are still in control at that level. Number 2, the Shanghai versus London premium. Right now it's $3. If that widens to $5 or $6, it means the physical shortage is accelerating and the Eastern buyers are in full panic mode. That's a buy signal for me. If the premium collapses back towards 0, it means physical supply is normalizing and the squeeze dynamics are fading. Number 3, the 21-day exponential moving average, which is currently sitting at $84. That's my line in the sand for support. If we get a violent stop hunt that takes us back down to 84 and we bounce hard, I interpret that as the last great entry before the next run. If we break below 84 on high volume, I'm reassessing the entire trade because it means something structural has changed. Here's the cliffhanger. If $100 breaks and holds for 48 hours, the gamma squeeze will trigger a run to $110 that no exchange, no central bank, and no short seller can stop. The derivatives will start to unwind, the ETFs will have to rebalance, and the momentum will feed on itself. Now let me tell you my personal battle plan, because this is where theory meets reality. I'm not a spectator in this market, I've got skin in the game, but I'm also not a gambler. I've been doing this long enough to know that pride kills more traders than bad analysis ever does. So here's my if-then logic for the next 2 weeks. Trigger A. If silver breaks $102 on high volume, I'm sitting on my hands. I'm not chasing. I refuse to buy into a vertical move that could be a margin hike trap. I've seen too many commodities rip 20% in 3 days, only to give it all back in 6 hours when the exchange steps in. If I don't already have a position, I'm waiting for the pullback. If I do have a position, I'm not adding here. Trigger B. If we see a violent stop hunt that takes us back down to the $84 support level, the 21-day EMA, I would personally look to add to my physical position. Not paper, not ETFs, physical bars. I see that as the last great entry before this thing goes parabolic. The weak hands will have been flushed out, the shorts will think they've won, and that's when the real buyers step in. Trigger C. If lease rates drop below 2%, I'm interpreting that as the squeeze being over. It means the banks found enough metal to cover their obligations, the physical panic has subsided, and we're back to a normal supply-demand market. In that scenario, I would consider trimming my paper gain ETFs while holding my physical core. I never sell the physical. That's the insurance policy. But the paper is a trading vehicle, and I trade it when the setup changes. Stop. This is my plan, not yours. You need to have your own if-then logic before the volatility hits. If you're just reacting emotionally to price swings, you're going to get destroyed. Write down your rules now while you're calm, so you don't have to make decisions in the chaos. Let me bring all this together. We have an inventory collapse happening in real time. 26% of COMEX registered silver gone in 7 days. We have a lease rate crisis with borrowing costs hitting 8%, which is a clear sign that the bullion banks are in distress. And we have a $100 price target that is being fought tooth and nail by every institutional short on the planet. Here's the rallying cry, and I need you to hear this clearly. The silver squeeze is not a meme anymore. It's not a Reddit movement. It's not speculative mania. It's a fundamental reality of the 2026 economy. The era of cheap silver is dead. The industrial demand is too strong, the supply is too tight, and the East has locked their vaults. The banks had 2 decades to accumulate physical metal to back their paper positions. They chose not to. They thought they could suppress the price forever through derivatives and naked shorting. They were wrong. And now the chickens are coming home to roost. If you want to understand how this ties into the broader macro picture, why gold is running toward $5,000, why central banks are buying at record levels, why the entire commodities complex is repricing, you need to watch my deep dive on the central bank gold reset. I break down the mechanism behind the de-dollarization trade and why this isn't just about silver. It's about the entire architecture of the global financial system being rebuilt in real time. You need the full picture to survive this, because what's coming next isn't just a price move, it's a paradigm shift. And the people who understand the structure will be the ones still standing when the dust settles. I'll see you in the next one.